Welcome to the Bullvine Podcast, your go-to source for inside stories, cutting-edge research, and the latest updates in the world of dairy farming. In the 59th episode, we dive into the global dairy market, surplus challenges, and rising protein demand. So please grab a glass of milk, sit back, and let's get started with this week's episode.
As winter approaches, the global dairy market is at a fascinating juncture, with grocery aisles filled with cheese and butter amid a perplexing surplus for producers. In contrast, demand for dairy proteins climbs, driven by health-focused choices. This intricate market dynamic reveals a contrast in pricing trends, with cheese and butter prices struggling under the weight of excess, as nutrient-dense dairy proteins enjoy a surge in popularity among health-driven markets. As U.S. dairy products capitalize on competitive pricing strategies globally, the coming winter season demands agility and foresight from industry players navigating these shifting currents. The need for strategic adjustments is urgent and cannot be overstated, underscoring the importance of the situation.
Last week's trading activities on major dairy exchanges reflected the ongoing dynamics and volatility in the market. At the EX, 4,590 tons were traded, with a notable distribution across different products, 1,685 for butter and 2,905 for SMP. The most active trading day was Wednesday, with 1,795 tons exchanged. On the futures front, EX butter futures, after a 4-week bullish run, witnessed a slight dip of 0.5%, with the NOV 24 June 25th strip averaging at €7,408. Contrastingly, EEX SMP futures experienced a positive uptick of 1.6%, settling at 254. Open interest in EEX butter futures increased by 182 lots to 3,402. In contrast, SMP futures saw a reduction of 131 lots, bringing the total to 7,114. Over the SGX, the dairy market showed significant activity, with 8,791 tons traded. WMP was notably active, with 6,202 lots, followed by SMP at 2,468. The NZX milk price futures contract observed 240 lots traded. Within this exchange, the SGX DOMA saw a robust increase of 3.7%, with an average price climbing to $3,887. SMP futures also rose by 1.6%, with the average price at $3,066. These statistics reveal a mixed landscape across the exchanges, characterized by slight declines in some areas and robust growth in others. They offer traders a vivid picture of the current market conditions and general trends shaping the global dairy market.
In a landscape flooded with milk's bounty, the dairy industry is caught in a paradox of abundance and scarcity, especially in cheese and butter. The surge in production is fueled by the rollout of new facilities eagerly designed to increase output, creating a wave of supply that threatens to drown under its weight. Initially hailed as triumphs of capacity growth, these expansions now appear as omens of oversupply. Yet, this upsurge in supply meets an unexpected roadblock: muted demand, particularly from sectors that once voraciously consumed these dairy staples. Food services, grappling with shifting consumer preferences and economic headwinds, such as specific economic factors, have not reached the plate as expected. Demand in restaurants and food processing has not kept pace with the heightened production levels. The mismatch between what is produced and what is needed is stark. This slack in demand hasn't just slowed the gears of commerce, it has actively reversed them, turning price trends downward. The dairy producers, orchestrators of this milk and cream symphony, now face a dissonant tune. With declining prices and storage costs mounting for burgeoning cheese wheels and butter blocks, the profitability that once beckoned them has become elusive. Navigating this market of dips and crests requires acumen and strategy. Carefully reevaluating production volumes and potential shifts in market focus may be imperative. Indeed, the challenge now is not just to produce, but to produce wisely, aligning output with realistic, sustainable demand projections. The price downturn has provocative undercurrents, urging dairy producers to reassess. As the gleam of high-value exports beckons elsewhere, managing domestic supply chains with precision and foresight becomes crucial. Thus, dairy producers are poised at a crucial juncture, balancing innovation in production with the wisdom of tradition as they seek to stabilize their footing on the tilting scales of the global market.
The sharp decline in cheese and butter spot prices reflects a confluence of overproduction and insufficient demand, which has become a defining feature of current market conditions. Cheddar showed an acute decrease in blocks and barrels, with blocks settling at $1.6925 per pound and barrels dipping to $1.68.5, marking their lowest prices since April. Spot butter prices mirrored this downward trajectory, plunging to $2.63, the lowest point since January. Two primary factors drive this drop: a steady production capacity, high output levels, and a saturation of stocks surpassing current demand. These dynamics create a challenging environment for producers, who face declining profitability as the market absorbs more dairy products than it demands. The influx of new cheese facilities designed to bolster production adds another layer to this dilemma. Although intended to elevate output, these facilities risk exacerbating the prevailing supply-demand mismatch. Consequently, prices will continue their descent, compelling producers to reassess operational strategies and market engagements. On the other hand, the broader market could see a ripple effect as these low prices spill over into other dairy segments, further straining the entire dairy supply chain.
The dairy market's narrative is shifting towards proteins as consumer demand finds new vigor, particularly among those using GLP-1 medications such as Ozempic or Wegovy. These drugs have fundamentally altered dietary needs, with millions prioritizing nutrient-dense foods amidst their reduced calorie intake. This consumer pivot to nutritionally rich options elevates the demand for dairy proteins, catalyzing a noticeable ripple effect across the whey and milk powder markets. Whey protein isolates, WPIs, and concentrates, WPCs, have emerged as critical beneficiaries of this shift. Their appeal lies in their high protein content, which provides maximum nutrition in smaller quantities, a significant advantage for GLP-1 users. As a result, producers are seizing the opportunity and increasing production to meet this burgeoning demand. However, this focus on highly concentrated products has led to a notable decline in the availability of less concentrated whey products, such as WPC 35 and generic whey powders, subsequently driving their prices upwards. The trend is not isolated to whey products alone. Non-fat dry milk, NDM, is also experiencing a price rally. International demand, especially from Asian markets, is boosting prices and putting upward pressure on NDM. The strategic realignment of milk utilization, drawn towards expanding cheese production capacities, means that less milk is available for drying into powders, further tightening supply and bolstering prices. This shift in milk utilization is a significant factor in the current market conditions.
Amidst the shifting sands of international markets, the U.S. dairy sector navigates complex dynamics that offer opportunities and challenges. Competitive pricing strategies have become pivotal, allowing U.S. dairy products to gain traction in international arenas, even as currency fluctuations pose challenges. Despite a strengthening dollar, which traditionally hampers export potential by making U.S. goods more expensive abroad, American dairy products' intrinsic quality and value proposition have held firm in enticing foreign buyers. The global dairy trade, GDT auctions, provide a clear barometer of international demand, with particular attention focused on milk powder and other high-demand staples. Robust purchasing from Asian markets underscores a persistent appetite for American dairy, bolstering overall export figures. This international demand has not only fueled a rise in milk powder prices, but has also served as a counterbalance to the increased production capacities emerging from countries like Australia and New Zealand. Ultimately, this delicate interplay between competitive pricing and global market demands is a double-edged sword for U.S. dairy. On one hand, it underscores the sector's capacity to remain competitive in an increasingly globalized market. Conversely, it accentuates the need for strategic navigation amidst currency headwinds and pressure from international dairy powerhouses. The future positioning of U.S. dairy hinges on its ability to leverage these international currents, ensuring that its products continue to captivate global markets despite the ebb and flow of economic tides.
In the current landscape, dairy producers contend with declining market conditions that echo through Class 3 and Class 4 futures. The consecutive downturn in Class 3 futures marks an unsettling trend, with contracts shedding roughly 20 drayts and values rocking in the high 18s to low 19 range. This trajectory points to increasingly challenging economic circumstances, striking at the heart of revenue expectations that were more promising in prior months. Class 4 futures are similarly beleaguered, weighed down by retreating butter prices. Contracts stretching from April through June see values dipping below the $21 threshold, signaling a broader trend of financial strain across the dairy segment. Such dynamics prompt producers to ponder strategic adjustments to maintain fiscal viability as milk checks inevitably shrink. Yet, amid these daunting futures, potential relief emerges from the feed markets. Recent climatic benefits, significant rainfall gracing the southern plains, have invigorated winter wheat crops, propelling wheat futures downwards. As a result, corn and soybean prices have also declined, with December corn prices settling at $4.24 per bushel, bringing some respite to dairy operators weighed down by production costs. This evolving cost landscape necessitates strategic foresight among dairy producers. While reduced feed costs are a beacon of hope, maintaining profitability in a volatile market requires financial strategy skills. These include exploring crop contracts to hedge against feed price volatility, optimizing herd management to boost milk yield efficiency, and mitigating risks through diversified product offerings to capture varying market demands. Though navigation remains complex, this multifaceted strategy offers a lifeline as the dairy market transitions through its current turbulent phase. It equips producers to brace against economic fluctuations and harness opportunities where they arise.
The current dairy market landscape reveals a striking contrast between production surpluses and shifting consumer demands. Cheese and butter face stockpile pressures amid declining prices, while dairy proteins experience a boom driven by health-conscious consumers. This dynamic creates a dual challenge: navigating the glut in traditional dairy products while capitalizing on the growing demand for protein powders. Producers must contemplate how to remain agile and competitive. With the allure of global markets buoying U.S. products abroad, are exports the key to sustaining profitability? Or should domestic markets realign to cater to the burgeoning interest in nutritional dairy options? As we witness these market shifts, producers must ask themselves what strategies will ensure survival and sustainable growth in an increasingly global and competitive arena. How can they strategically manage production to align with these evolving demands?
Thank you for tuning in to the Bullvine Podcast. We hope you enjoyed today's insightful discussion. Don't forget to subscribe, share, and leave a review. Catch you next time on the Bullvine Podcast, where bovine expertise and community come together.